Hey traders, welcome. Shane from Global Market Trader. I'm just going to take you through a quick video presentation on trading the stochastic with success. Now this is a very common indicator found on most charting packages that you can't come across when you first start trading. So what I want to do today is take you through the stochastic oscillator is and how to use it to get an edge in the market. So let's jump in. First thing we need to do is let's jump in now and have a look at what the stochastic indicator is, a momentum oscillator. So what that basically means is that evaluate the market's momentum by determining the relative position of the closing price within the high-low range of a specific number of days. So depending on how many days back you select. So for example, typically a 14-day stochastic measures the location of closing prices within the total high-low range of the previous 14 days. This expresses a relationship between the close, the high-low range as a percentage between 0 and 100. So therefore a stochastic value of 70 higher indicates or tells us that the close is near the top of the range, and a stochastic value of 30 or lower means that the close is near the bottom of the range. So therefore in a robust uptrend, prices generally close near the top of the recent range, and in a strong downtrend, prices will usually close near the bottom of the range. It's potentially approaching a turning point in the market. Prices begin to close further away from the high of the range. Conversely, when we're in a downtrend and that is starting to weaken, prices will tend to close further away from the low of the range. So the purpose really of this stochastic oscillator is to alert us as traders as to a potential failure of the bulls to close prices near the high of an uptrend, and the potential inability for the bears or the sellers to close prices near the low of the downtrend. So we're looking for that potential divergence there. Traders, we're going to have a look at the stochastic now on our chart. So we have a stochastic slow 1433. We've got the settings on the chart as 20 and 80. So what they represent are the upper and lower bands of the stochastic. So that can be placed at as low as 70 and as high as 30 on the lower end. And remember that this is a banded oscillator. So what that means is that we've got two areas that we're specifically looking at as far as areas of interest, and they are areas above 80, which is what we consider to be overbought, and when our oscillator pushes down below 20, then we're considering that area to be oversold. So as a banded oscillator, we're looking for our percentage K line, which is our solid line here, to move above the 20 line to give us a potential buy opportunity or a look at a possible bullish momentum, and likewise when it turns and crosses below the 80 line, we're looking for a potential sell opportunity. So the percentage K line, which is our solid line there, that oscillates above and below the 80 and 20 line, and that's one way in which many traders, when they first start looking at the stochastic, look at potential ways to trade this indicator. So there are three primary ways in which you'll find that traders actually use this indicator to trade with. So the first one is to use the percentage K line as an indication of when the market is overbought or oversold, and across below the 80 line is giving you an indication that there's potentially a selling opportunity. As you can see here, it picks that up nicely on this push down. We've got heating oil here on our charts using Renko bars, and you can see that trade works well. Then we get a push down, price spends a little bit of time below the 20 line, and then we get a move back up, and that gives us a potential small buy there. But what you'll find is that typically if you just use the indicator